Hey everyone, thank you so much for coming in and joining us today. I know this is a little bit earlier than we usually do it, but we got a special guest here. As you can see, Charlie. Charlie is a good friend of mine. He's a wonderful financial planner, and he's one of the rare CFPs and CPAs. Um, yeah, Charlie, how are you doing today?
I'm doing good. I got my coffee for this early morning special here. Yeah, doing well. New Year's was well. I have three kids, so New Year's was at home, and fortunately, we have a daughter who's a little sick, so didn't do very much. But bringing in 2024 strong with Larry here.
Oh no. Well, I'm sorry to hear that daughter isn't feeling well. I hope she gets better here soon. Um, Charlie, why don't you give us just like brief kind of background of yourself? How'd you get into financial planning? What work at a firm, own your own firm? Just tell us a little bit about yourself.
Sure. So mine goes back to college. So when I was in college, I didn't know what I wanted to do, and my dad's a CPA as well, so he's an accountant. And I'm like, all right, well, I don't know what I want to do. He's like, hey, go into business or accounting because you're always going to have a job. So I'm like, all right, well, that's good, security. So I went into accounting in college. Then I went into public accounting after college, and it was neat. Got to travel a lot in auditing. And what was bad about it is it's just so many hours. Like they work you like a dog. And I was just like, oh, I can't do this. So I went into corporate accounting after that. And corporate accounting, there's no travel. The hours are better, but you're behind a computer all day and you're just doing accounting. It's no fun. So I'm like, oh my gosh, this is horrible too. So then ever since college, I always wanted to give back, do some type of service work. And I decided, you know what? This is a time in my life. I wasn't tied down, didn't have a wife, no kids. Decided I'm going to take a year off and do some service work. So I worked with an organization where I was reaching out to kids and had nothing to do with financial planning, nothing to do with accounting. Um, and with that, I loved it. I really enjoyed just giving back to people. So flash forward, that was a year-long program. Went back to my house, and I was back in Illinois, and I'm thinking, okay, now what do I want to do? I really wanted to use my CPA to help people. And that's where I started to learn about NAPFA, which is financial planning organization. And I learned about just whole financial planning in general. I didn't even know what a CFP was. I learned about that. And then from there, I met up with a fee-only financial planner in Chicago. And I started working for her, and that's where I really got my feet wet. She was a CPA as well. We prepared taxes during the financial planning process, and I really learned. And then from there, I decided, you know what? I think I can do this myself. There's some ways I want to change it, and decided to get my feet wet, and here I am. So I opened up my firm in 2018, and as taxes, and then I got registered in end of 2018 for financial planning. I've been doing that ever since, and it's been wonderful helping people. I really enjoy it.
Very nice, and glad to hear that. Yeah, you got started, learned, and then decided to come to this side, open up your own firm. Do you are you a fiduciary, Charlie?
I am a fiduciary. Yep. So I'm fee only, and I'm fiduciary to the CFP board, which is where Larry and I are from. Our CFP. And then I'm also fiduciary through the AICPA, which is the American Institute of Certified Public Accountants as well.
Oh, interesting. I didn't realize you get like the double duty there.
I get the double duty. That's right.
That's great.
That much put your interests in front.
Okay, so good to know. Fiduciary, fee only planner. Well then, let's jump into the good stuff here that the people want. So, Facebook group with Roth conversions. We talk about it a lot. Should you do a Roth conversion? Should you not? What are the things to think about? And I continuously got questions about, well, okay, not even so much of should I pay the taxes for the Roth conversion by withholding, or should I pay with outside funds from the Roth conversion? But like literally, Larry, like, how do we pay the estimated taxes? And there's these penalties, and I hear horror stories like, oh, I did this huge Roth conversion, just decided to pay the taxes in April. I got hit with these big late payment penalties or underpayment penalties. What's going on? If you've ever looked at the IRS form like 2210 for it. It's really scary. There's a lot of numbers. It's freaky. So I thought I need to get a CPA on here, get to the bottom of this. And I thought no better person than you, Charlie. So I really appreciate you coming on. And I think this is going to be really helpful for everyone.
Excellent. And I appreciate you inviting me. So I'm excited to do this.
Of course. Well, then, of course, guys, before we jump into it real quick, we got to get compliance out of the way right here. So Charlie and I, our firm's Optimum Retirement Planning and Focused Up Financial, are registered investment advisors, and basically all the information today that we're talking about is educational in nature. So it's not specific advice for your situation. This isn't specific tax, legal, or accounting or investment advice. We're just talking about stuff and general educational concepts. And of course, your situation can always be different. So always talk with your tax, legal, or investment professional before taking any action on your situation. All right, the boring stuff out of the way. Let's get into the good stuff. And actually, before we do jump into the good stuff, Charlie, what's something like fun or unique about you for the viewers, just so they get an idea of your personality?
Sure, yeah. So I think one thing that I've been doing my whole life is I'm trying to get to all 50 states. I've been to 41 states, and that is from growing up. We took road trips, and then with auditing, I went around to many places you probably don't want to go, but they're kids. And that's one of the things that I want to do is try to get all 50 states. So I'm on my way there.
Do you know like your number, like how many you have right now?
Yeah, 41.
Oh, 41. Nice. Oh, wow. So you're almost there.
Yeah, but there's also those states like the small. I got to go to the East Coast because there's like you can knock out like 8 of them that I haven't been to, like Vermont, Connecticut, stuff like that. So,
have you been to Alaska?
I have not, but I have been to Hawaii.
Okay. I feel like Alaska is a big one where like everyone gets tripped up by that, and the Montanas or Dakotas and Montana.
So that was part of it. So, real quick story. Back in the day, my parents they bought a car in Seattle because my dad worked for a corporation with plants all over the nation. We bought a car in Seattle and drove it back to Illinois, and we hit a lot of states that way. Montana, we went to Yellowstone, Idaho, South Dakota. We saw Mount Rushmore. All those states up there that aren't very populated. We got to, which is really cool.
Incredible. All right, so Charlie's a big U.S. traveler, 41 states.
I am.
Hopefully, do you have an age range? Like, hey, by certain date or age, I want to hit all 50, or it's just
no. There's not, but thinking about that, it's making a family affair now, and get my kids involved, and so do it. Let's say before they're in college. So I have my oldest daughter is 5, so I have 13 years to do it.
Okay. Yeah, so that's less than one per year too. That's easily doable.
That's right.
All right. So estimated taxes, how do we avoid penalties for tax underpayments? And obviously as US citizens, when we earn income, we got to pay taxes. No way to get around it. And it's the good and bad that comes with the privilege of being a US citizen. So Charlie, when does the IRS actually require payments for your taxes? Like I made some income. Like what are my requirements around paying those taxes for that?
Great question. So traditionally, everyone knows April 15th, tax day. Got to get your taxes in. The post office used to be, I don't know if it's still open, but it used to be open until midnight that day. So people do get their taxes day. If you know The Simpsons, there's an old Simpsons episode of Homer throwing his tax return in when the doors are shutting. It's a good episode. So April 15th is the traditional tax day if you're a year-end filer. So what that means is 12/31 is a year-end. Most people, for individual taxes, the end of the year is 12/31. And it's not April 15th. It's actually the 15th day after the 4th month of your year-end. And why that is because if you're not a year-end filer, and you don't have to be, you could file when, you can have a fiscal year-end. And what fiscal means is you can have a different date that your year-end closes. A lot of businesses do this. So traditionally, it's a 15th day after the 4th month of your year-end. And With that, if it falls on a Saturday or Sunday, the 15th, it is the next business day. So sometimes it'll fall on the 15th and we don't have to pay taxes until the 17th. You're like, oh, on the 17th, but the 16th is Monday. Why are we paying the 17th? That's because in DC, there's a holiday on the Monday of on the 16th of April. So they don't require it. It's always usually the 17th. If it's on the 15th is on a Sunday.
And so that 15th or 17th day, you can pay your taxes on that day, and you're still good. They say okay.
So that's tax day. We pay our taxes all through the year. So to clarify, so if you pay your taxes, that's the day that if you don't pay your full taxes by the 15th, there is a penalty called the failure to pay penalty. We'll get to that a little bit later. But how taxes are paid are throughout the year. What the IRS requires is that you make payments throughout the year in 25% increments. And there's this thing called estimated taxes where you're supposed to pay 25% of your taxes in April, June, September, and January of the following year for the preceding year. And the reason they do that is because they don't want someone just to be holding all their cash and then they make this huge payment, because we live in the United States, we fund the United States, and they need money to run the government. So the Social Security checks that some of you might be getting is we're paying for that, and I'm sure you want that to continue. So we want to be paying taxes throughout the year. And how we do that is if you have a job, you don't get your full paycheck every time you get paid. You get taxes withheld, and that's how they take it out. They withhold taxes through paychecks. And then if you don't have a W-2 job, if you're retired, let's say, then you can pay through your distributions. You can get withholding through distributions of your qualified accounts, and qualified means a retirement account. Or you can also make what's called estimated tax payments. And an estimated tax payment is when you write a check to Uncle Sam, aka the IRS, and you pay it with one payment voucher, which is a payment voucher is where you pay your taxes for that quarter. And you write a check or you do it online, and then you pay taxes that way. So the two ways, long story short to say, is estimated taxes is one way, and then withholding is the other way. But we want to be paying throughout the year, so we get those Social Security checks. Those Medicare keeps going around. You can see your doctor, and the government is funded.
Got it. Okay, so just to kind of summarize that real quick, excuse me, is it fair to say that the U.S. tax system is kind of like pay as you go? Like you earn the income, and they give you a little bit of wiggle room. Like, hey, you got until the 15th of that end of the quarter, but you've got to make the payment roughly around when you earn the income.
Yes. However, there are just with everything with taxes, there's caveats.
Yes.
So there's called the safe harbor rule. And what the safe harbor rule means, in order not to be penalized, you have to pay at least 90% of this year's taxes due by the January 15th, or you have to pay 100% of taxes from last year by January 15th of the next year. And if you make over $150,000, that gets bumped up to 110% of last year's taxes. So real simple, let's say you make $10,000 in a year, or let's just say $100,000. You make $100,000 a year, you pay taxes at 10%, $10,000. Then and that was for 2023. So when you do your 2024 taxes next year, you either have to pay the minimum of $10,000 or whatever your new taxes are going to be. And let's say your new taxes, you only make $80,000 in 2024. You're still in the 10% bracket. I know these don't jive with current tax code, but let's just say you owe $8,000, you'd have to pay at least $8,000 by January 15th.
Got it. And now you're going back to that 2023 example, you earn $100,000 per year. You're earning $8,000 a month. can you make that you owe $10,000 for taxes, for example? Can you make that $10,000 payment like January 15th of 2024?
You can, but you'll be penalized.
Okay.
You can
So
do whatever you want. You don't have to pay taxes, but you'll be penalized for that. So
okay. Well,
So to answer your question, you have to pay 25%. If you're doing estimated taxes, it's got to be 25% increments. And it's supposed to match up, like you said, pay as you go when you earn the income. So let's say in quarter one you make $10,000, you pay taxes on $10,000. Let's say for the year though you're making $300,000. So the first quarter you pay $10,000 tax. Quarter three you get a big payment. You get $250,000 in quarter three. That's when you want to make your big payment in quarter three to match up when you get the income. Because how it works is they're going to start a clock if you're underpaying. So quarter one, you're fine. Quarter two, you're fine. Small taxes. Quarter three, that big tax bill comes. You don't pay it all. Then they start a clock and they say, okay, you're underpaid from September 5th, 16th on. So we're going to start a clock and you still haven't, then when you pay your next quarterly payment, that will go to apply on your outstanding balance. That won't hit what's current. That's going to hit the outstanding balance, and then you're going to have that balance be satisfied, let's say, but then you have an underpayment for the next quarter, and that clock keeps ticking. And then when you go do your taxes, there's this little box at the bottom of your 1040 that says estimated or penalty, estimated payment penalty. And that's where the IRS pays, that's where they catch up with the penalty. They're going to charge you a penalty when you file your taxes because you're late.
Interesting. I like that idea of the clock. And it sounds like the IRS is actually kind of giving you the benefit of the doubt by applying it to that past due payment instead of letting that run out and saying, oh, hey, like you make quarterly payment, this will apply to like the newest quarter. You still have this out due balance. They're kind of giving you the benefit of the doubt there by applying it to your longest outstanding tax payment due.
Right. And then just so we're clear too, you don't have to pay by January 15th. Like I said before, if you don't pay, you're going to have a balance due when it comes to file your taxes. But depending on the safe harbor and everything, you may or may not get a penalty. So if there's questions and things like, oh, we got to pay everything by January 15th, that is a caveat because your tax situation is unique to you. You got to have someone review your current taxes. You may or may not get a penalty depending on all these other situations that we're talking about.
Okay, so yeah, it gets complicated, but so really simple. Again, we're starting real simple. We'll get into the exceptions. It sounds like, hey, if Q3 of 2023, I owed $1,000 in taxes, didn't make the payment for whatever reason, that clock starts, I haven't made the payment, I'm going to be penalized on this somehow. Q4 comes around, I make $1,000, I owe $1,000 in Q4 for payments. So if I only pay $1,000, that just pays off my Q3 balance, which was $1,000, and then I still owe Q4, and that clock will then run starting January 16th, the last. Right. Okay.
And that's where you mentioned Form 2210, and that's where you see it all come through the paperwork if you fill out that form.
Okay, yeah, and that thing is like yeah. I mean, and there's all these different methods, and you look at it, it's I think I honestly think it's the most complicated tax form I've seen. What do you think about that?
I don't. I think that the COVID repayment over the 3 years where you could take a retirement distribution was a nightmare.
That was where
it like that, and that was no fun. So,
okay, wait. Explain just real quick. What are you referring to?
So during
there?
COVID, you could take up to $100,000 out of your retirement account before you were the age of 59 and a half. So 59 and a half is a traditional age where you don't get penalized if you take anything out of your retirement accounts. Now, in the COVID years, they said you could take up to $100,000 under age 59 and a half, and not be penalized. You still pay taxes on it, but you aren't penalized. And they gave you 3 years to pay that back. And this is what happens with the IRS. It's Congress will make a law, and then they're like, all right, IRS, figure it out. This is what we're doing. And then the IRS scrambles, and the IRS is really underfunded, and no one knows what's going on, and we're waiting for information as a CPA. It's like, what are we doing? And then the tax software has to get all these forms in, and the tax software is scrambling, and there's bugs in the system. It's a nightmare. The form is 8915, and it was no fun. It was no fun at all. I'm not going to bore you with the details, but it was just that was a complicated form, and Congress might make more complicated forms because they're cooking up ideas all the time. And in 2026, we're supposed to go back to the old tax system. We'll see what happens. Maybe they'll do something different with new forms and new fun. So,
the fun of tax planning, the joys of tax planning. You never know what you're going to get in the future. Okay, interesting. So I want to get into the penalties and exceptions and
sure.
payments and all that. But real quick, I think I want to go back to what you said earlier, that there's basically two ways to pay your taxes. And I think you said there's withholding and there's estimated payments. Am I correct there?
Well, yeah. I mean, so 2 ways where you can pay your taxes through the year. And then there's also the ways that you can actually physically pay, like write a check, et cetera, et cetera. But yes, so to pay your taxes, you have estimated payments and you have withholding.
Okay. Could you give us the breakdown? What's the difference between those two types of ways to pay?
Sure. So withholding, how that works is if you have a W-2 job, so you work for somebody else and you get a paycheck, the IRS and the state of Illinois or whatever state you're in, if it's a taxing state. So if you live in Texas, no taxes good for you. But if you live in a state with taxes, then they're going to take it out of your paycheck. So say you make $1,000, you make $52,000 a year, and you get paid $1,000 weekly. You don't get paid $1,000. You're going to be like, oh, guess what? We're going to pay the IRS, $100. So now you only get $900. Then the state of Illinois comes in at 4.95%, and they're going to be like, we're going to take our cut. And then we pay FICA, which is Social Security and Medicare. And that's, we all pay that in, and we collect it when we're after 65. But they take their cut. And then if you make enough money, then you get additional Medicare taxes and additional taxes and a NIT and all these other fun taxes that you may pay. So all that's coming through your paycheck. So when you actually get your paycheck, you're like, I made $1,000, but I'm only getting $680. What's the deal? It's because of that. And then there's other things too, like benefits that we won't get into, but that can additionally decrease your paycheck. So that's withholding. Withholding doesn't have to be through a paycheck though. It could be through Social Security. You could have Social Security withheld if you want to, like taxes for Social Security. You could have withholding on your retirement distributions. You could have withholding on pension. You could have withholding on annuities. There's many different ways, especially in retirement, that you can still withhold. So not just paychecks. And then the other way is...
Wait, Charlie,
yes.
Real quick, while we're on withholding, you mentioned so you can get withholding from Social Security, wages, pensions, annuities, IRA distributions, a lot of different ways to do withholding. Can you do withholding from all, like how about capital gains, dividends? Can you withhold on those income sources?
That's a good question. So when it comes to capital gains and dividends, I would say contact your institution. So if you work with Fidelity or if you work with Charles Schwab, they may be able to do that. But traditionally, if you have a big capital gains distribution, like let's say you sell stock and you make $50,000, you'd want to do an estimated payment traditionally. However, I don't know all the institutions and what they allow and what they don't.
Sure. I mean, I can say I've never personally seen somebody be able to do that. I don't know about in your experience if you've seen it.
I haven't seen it, but I don't want to say, no, it's not available. And then, let's say Fidelity's like, we got this new system. Hey, come with us.
Yeah. So really it's about there needs to be a system in place to withhold from it. Not that necessarily you couldn't potentially withhold from capital gains. It's just there's no system built to do it.
Yeah, there needs to be a system, and then the IRS needs to allow. So they most likely would have to work with the IRS and everything, because there's got to be a way to remit the taxes. Because what withholding is it's not going to the IRS right away. Your employer will hold the taxes that they withheld or taken out of your paycheck and put it into an account. And then 4 times a year, they make estimated tax payments called payroll tax, and they remit that.
Wait, so they get your cash for free with withholding, essentially?
They don't remit it right away. They do it through payroll taxes, and they remit. They have tax filings as well that they got to do.
And this goes back to like those 4 quarterly payments you make through the year that we were talking about earlier. They're on that same, the employer's on roughly the same system of like, we withhold the money and then
those but it's a different system. I mean, it's based on,
it is different.
Based on their fiscal year end and everything. So
it gets more complicated. Okay. We don't need to go down there because we're talking about individuals primarily here. Okay. Interesting. Okay. So then withholding, how about estimated payments?
Yeah, so estimated payments are you write a check, or there's different ways to pay it. And then you say, okay, to U.S. Treasury. And that's how you want to write a check to the government for taxes. It's U.S. Treasury. You put your Social Security number on there. You put your amount due. Then you have what's called a voucher payment if you do it by paper. And it says, I'm going to pay $1,000. And you write the check, include it, mail it off to the IRS. And then that goes against your taxes for that quarter. But if you're late, remember what we talked about. There's that system that it will catch you up. But that's how. So you actually physically write a check and you give it to the IRS, or you do it through. You can go on the IRS website electronically, but it's actually physically writing a check or giving the IRS money versus having it come out of your paycheck. It's going from your bank account to the IRS, whereas withholding it's going from another institution. They're taking money and keeping it back, and then it goes to your bank account. So think about it from you giving it to the IRS, or somebody's giving money to you, but not the full amount is withholding.
Interesting. Okay, and so estimated payments, really simple. You earn money, and then you send a check. You pay the IRS some way, more or less.
Exactly.
And you've got a deadline to do it. You don't get to stretch it out a whole year. There's these 4 quarterly payment deadlines where you gotta make the payment by.
Correct.
So then what's like in general, what do you have any ideas or thoughts on, like, should you withhold? Should you use withholding? Let's say it's an IRA distribution. You're taking money out of your IRA, you're over age 59 and a half, don't need to worry about the 10% early withdrawal penalty. Is there advantages to withholding taxes from that payment versus making an estimated payment? Any like pros and cons to each?
Yeah, it really all depends on your individual situation, if you should withhold or if you should pay an estimated tax payment. Like, for instance, if you don't have the money in your account to pay the estimated taxes, well, withholding sounds like a lot better idea because you don't want that penalty. And penalty right now, it's based on federal rates, and penalty rate right now is 8%. So it's a big rate right now. Back when rates were low, it was much better. But yeah, it's a pretty significant penalty for right now for underpayment penalty. So to withhold or to do estimated tax payments, it's really based on your situation. I can give you some high level pros and cons of it. And remember, this is just high level. This isn't about your situation. So with that, when it comes to estimated taxes, one of the great things if you do a Roth contribution is if you can have money that's outside of that conversion, pay your taxes, all that money can go and work for you in the Roth account. Versus if you withhold, then you're taking some of the money out that can't grow for you anymore. It's going to Uncle Sam to pay your taxes. So that's a plus for having money outside of your distribution to pay for taxes. Now, on the withholding front, one of the reasons to withhold is we talked about estimated taxes, and they have the 4 quarterly payments and the underpayment penalty, and when you pay it, you should match it up with your income, etc. But with withholding is treated from the IRS as it's made equally throughout the year. So if you withhold in December, you're actually withholding throughout the year, even though you withheld in December. So that means when it comes to that calculating how much taxes you owe, if you make a $100,000 withholding in December, they're going to treat it like you did that equally throughout the year, which will help with an underpayment penalty. So that is a plus for withholding.
Interesting. Okay, so I want to dive into that, but I think we need to help everyone understand the penalties and whatnot a
Sure.
little bit more, and how to avoid those and whatnot. And then, but that's sounds like a big gold nugget there, which is withholding is applied equally through the year, which could be helpful if, for example, you had a capital gain distribution earlier in the year, forgot to make an estimated tax payment, and it's at the end of the year, and it's like, well, is there any way to reduce my penalty? Withholding could potentially be one way to help at least reduce the underpayment penalty.
It could, yeah.
Okay.
And there's
okay.
other ways too to reduce it, but yes.
Great. Okay. So then, real quick, while we're on, before we get into underpayment penalties and all that good stuff, I hear all the time from people, hey, I got a bonus for the year, whatever it is. And like, my bonus is taxed differently. Like there's more taxes on my bonus. Charlie, are bonuses taxed like differently? Like, are they classified as different income and have a special tax rate or anything applied to them?
I'm smiling because just like with anything, it depends. So, and that's kind of the answer with everything IRS is it depends. It can have a different tax rate. So there's 2 ways to pay a bonus. You can pay a bonus through the paycheck, just like a normal payroll. And if it's on a normal payroll with your other pay, you're going to be with the normal withholding for yourself. So you're going to fill out what's called a W-4 form with your employer, and you're going to check a box that says, the old way, most people remember exemptions, 0, 1, 2, 3. The new way is actually you fill out of the form because there's no more exemptions temporarily. There is, but it's 0. But the W-4 form is what you tell the IRS how much to take out. And the new W-4 form is awful. Many people mess it up. It's so bad. We can get to that a little bit later. But when it comes to the withholding and the W-4 form, what you want to do is you want to try to get that right to match up your taxes. Now we'll go back to bonuses though. So the bonus is going to match, if you get paid with your normal payroll, it'll match up with your W-4. Try to do it as much as possible. The second way a company can pay a bonus, so that's way 1. Way 2 is through just a bonus payroll. And a bonus payroll is taxed differently. It's taxed at a flat 22%. And if you're in a high tax bracket, you're going to be underpaying, and you're going to get a tax bill due. Because if you're, let's say, in the 35% bracket or 32% bracket, then you're going to be underpaying because it's taxed at a flat 22%. You got to take that into consideration. You don't want to just go and spend all your bonus on a Ferrari if you're a big roller or something like that. But you want to make sure you spend some of that money and keep it in a high interest bank account so you can earn some money while you wait for the taxes that are coming your way.
Now, when you said bonuses, there's a special bonus. Are you saying this bonus income, if it came through my normal wages, would be taxed at 35%, but if my employer uses a special bonus payroll system, it's only taxed at 22%?
So how it works is, so if it's a bonus payout, it's taxed at a flat 22%. But I want to touch on what you said earlier. It won't be taxed necessarily at your rate. For instance, and I've seen a lot of people get in trouble and try to work with clients on this, because if they leave a job and they go to a new job, then the job is going to say, okay, well, you've been here for 3 months. You're making $100,000 a year, but let's say, you're only making $30,000. So we're going to tax you at 10% because that's how much you're making with us. They're not taking into consideration all the money they made at the last job. So that's why that new W-4 is so important. So everything gets captured. You got to put your old company's wages in there and everything. Otherwise, you can under withhold, especially with a bonus. So then a bonus could even be under 22% because it's following your wages that you've only been at the company a month or 2 or 3, and then it's not capturing all your income for the full year if you don't fill out that W-4 correctly.
Got it. So the bonus, there's a special system. It can be withheld at 22%, like flat 22% rate.
Flat 22, yep.
It doesn't mean it's actually taxed. Like it could be taxed at 30% or 12%.
Right,
it just depends on your situation.
Your tax rate. What is income?
But they put a blanket withholding on it, withholding rate.
Wait, say that again, Larry?
They put it like a blanket withholding rate of 22% sometimes on bonuses. And that's where some of this confusion can come in of like, oh, my bonus is taxed differently than everything else. What's going on here?
Yeah.
Okay.
So let me clarify that. It's a great point. So it's not taxed differently. Your taxes are based on the income you make. So if you go to the Price is Right and win $10,000, that's taxable income to you. That's bonuses taxable income. Wages, IRA distributions, if it's a traditional IRA, that's all taxable income. That all goes on your 1040 or your personal tax form. Whereas withholding is what is set aside for you to pay your taxes. But it's not the taxes you owe, it's the taxes that are set aside to pay the taxes that you're going to owe.
Great clarification.
Did I lose you?
Thank you. No. It makes total sense. So those withholding taxes, all withholding is, hey, this is what I think I'm going to owe, so I'm withholding it to make sure I pay that. But that can be different from what you're actually required to pay, essentially.
For sure.
Great. Okay. So always want to clear up that bonus because I hear it a lot. So thank you, Charlie, for getting to the bottom of that one for us.
But and just real quick on that bonus thing, if you are getting a bonus, it would make sense to do a tax projection to make sure that you're properly withheld in a bonus, especially if you're a higher earner or if you're going to make a big distribution and you're going to get a bonus from, you're retiring from a company and they're going to give you a bonus payout, part of your severance package. You definitely want to be looking at some projections to just make sure that you're not going to get hit with that 8% underpayment penalty.
And I guess, and that 8% underpayment penalty, is that like 8% annualized for the year? Is that 8% per quarter? So it's like, credit card interest rate when you add it all up?
Yeah, great question. So that's the annual rate. So if you're 1 day late, you're not going to get 8%, but it's going to be annualized at 1 day out of the 365 days.
Got it. Okay. And they accrue interest daily then?
And that's where that Form 2210, like it's basically how much you're supposed to pay.
Okay.
So yes, they start accruing it right when you're late.
Got it. But so that's good to know. If you're a day late, it's not like you get hit with 8%. That takes time to accrue, but it's at an 8% rate. So just like a credit card, like, hey, I made a late payment, I'm gonna owe some money. You want to make sure you pay it off and don't get hit with that interest.
And that's a variable rate too. So right now it's 8%, but that is actually the federal short-term rate plus 3%. So when the federal short-term rate changes up or down, that's going to change up or down. On the flip side too, what's really cool, we're talking about a penalty. That's also the rate that the IRS pays you for overpayments. So let's say you have a tax extension and you don't know what you're going to be paying. You got to pay your taxes by April 15th. And that's the rule. You can have an extension. It gives you more time to file, but you got to pay all your taxes by the tax due date, which is April 15th or 15th day after the 4th month of your filing of your year end. But if let's say you're making a big extension payment because you don't really know, you're waiting for some type of tax form, like a K-1, which is a tax form that comes late usually. But let's say you don't know and you make a big tax payment and like, oh my gosh, I'm gonna get $3,000 back because I overpaid. The IRS pays you 8% on that because it's past the filing deadline. Or not filing, the payment deadline, and that you overpaid.
Wait. So what's to stop someone, like bonds are only giving me, 4 or 5% right now. What's to stop someone from just like giving the IRS a bunch of cash and being like, oh, I'm going to earn 8% on this? Cash, I'm overpaying the IRS on my tax return.
Great question. That's a good question. So you can do that, but there's got to be justification for it because there's another penalty right here. That's and actually looking up this, Larry gave me these questions and I learned some stuff with all these different penalties too. So where is it? I'm just looking. I got a second screen here. It's the erroneous claim for a refund penalty. So that applies when you submit a claim for a refund for an excessive amount that does not have reasonable cause.
The erroneous?
The erroneous claim for refund penalty.
What a mouthful.
Yeah. So basically, that's like saying you can't do what you're doing without a reasonable cause. Like if you have a cause, like I don't know what it's going to be. I'm waiting for my numbers from my accountant or from my company, whatever.
Right.
It's a reasonable cause. But if you're just like $300,000 at 8%, the IRS they're going to get you. So.
And they actually like penalize you for that. It's not even just like we're not paying that. Like we're not giving you the 8%. Go away. Do they add on a penalty to that as well?
Yeah, there's a penalty. And I want to put a caveat here. The IRS isn't going to get you. You could do what you want to do, and you could roll the die. I do not recommend it at all. Don't do this. Just like anything, the IRS has the audit arm, and they can audit you. And if they audit you, they're going to fine you, they're going to penalize you, and they're going to put those interest charges on you.
Okay. So I don't want to derail us further with this line of thinking of that, but you just said it. So this is great though. I want to go back. You said, hey, you get a bonus payment. You need to make a tax project. You recommend strongly getting a tax projection from a tax professional to make sure that you're doing the correct withholding. You're not going to get hit with this 8% interest penalty down the road. How should we normal, I know let's just say normal person still working, maybe pre-retiree, a couple of years from retirement. How should they determine the right amount to withhold from their paycheck? Like you got this withholding, form W-4 is kind of like gibberish. What's the best way to go about that?
Yeah. And so the IRS, after they came out with this new W-4 form, so the form during 2018 to 2025, we're in this Tax Cuts and Jobs Act, tax rates and everything. That's the new W-4 form. The IRS came out with this calculator on their website that I strongly recommend that you go through, and they're going to ask you personalized questions. You're going to need some pay stubs. Go through that calculator on the IRS webpage to figure out what your W-4 should be. And do it early in the year so you can be on track throughout the year. Because you can do it whenever you want. But let's say you do it in October, you're going to have additional withholding to catch yourself up if you're under withholding earlier. But the IRS webpage, the W-4 calculator is a great place to go.
Okay, I just put a link to it. That's the tax withholding estimator.
I believe so. Let me see the link here.
Yeah, to change your tax withholding amount in your W-4. Use your estimate to change your tax withholding amount in your W-4. Keep the same amount.
Tax withholding estimator. Yes, sir.
Yep. Okay, great. So
to let you know, there is an outage as they update the new numbers for 2024 taxes. Because remember, we're withholding for 2024 now. We're not paying 2023 taxes anymore unless you make an estimated tax payment. Any money you make now, though, is part of 2024's taxes, which will be filed in 2025.
Interesting. So withholding is your fiscal year, which for most, we're just going to assume this is an individual, your end of 12/31, so you're on the calendar year is your fiscal year. Withholding on 12/31/2023 is for your 2023 taxes. You withhold January 2nd, 2024, that's for your 2024 taxes.
Well, it can be. If you withhold, you can make a payment you have until January 15th of the next year to do your Q4 payment for estimated taxes of the previous year. And the reason they do that is because then you can have final numbers. If your year ends 12/31 and you don't know how much you're going to make, say you have a business and a big check comes in on 12/30, and you don't have that information if you're doing it a week before, the IRS wants to give you the time to have all the money come in or know how much is going to be coming in for year end. And then they require the Q4 payment will always be January 15th if you are a year-end taxpayer. I wouldn't say always. Remember, it could be the 17th or the 16th if it's on Saturday.
Yeah, there's caveats here, but so that's the estimated payment, January 15th or whatever it is. That's making an estimated payment. But can you use withholding and still do it? Like if you do withholding right now on the 2nd, that can still apply to 2023.
Gotcha. Good question. So withholding on your paycheck for 2024 will be 2024.
Got it. And you can't say, no, I want this for 2023. Like,
no, unless there's some type of, caveat or exception where there's like some kind of weird thing with payroll in the last week of the month. But no.
Got it. So that's when you have to use the estimated payment method. If you're in 2024 and you want to pay taxes for 2023 in general, most of the time, you got to make the estimated payment.
Correct. And that's until January 15th.
Got it. And that's going to be key. That's going to be key when we start talking about Roth conversions and like making the payment for it for people. So, okay, let's get to the fun stuff, which is, so Charlie, we talked about this 8% interest payment or interest rate if you don't pay your taxes. How does the penalties work on kind of a high level? First off, like you don't pay enough taxes, what's the IRS going to penalize you for?
Yeah, so there's two major penalties. There's the underpayment penalty and the failure to pay penalty. I should say three: failure to pay penalty, underpayment penalty, and the failure to file penalty. So failure to file penalty, real quick, it's you don't file your taxes, you owe money by April 15th. You don't ask for an extension. The failure to pay penalty is you don't pay your full amount of taxes due by April 15th. So that's separate from the underpayment penalty. The underpayment penalty is about estimated tax payments. So the failure to pay penalty is about tax deadline. And the underpayment penalty is about this throughout the year pay-as-you-go type of thing that we're talking about. And the underpayment penalty will be assessed on how much money you make throughout the year. So like if you make a lot of money in Q1, you're going to want to pay that in Q1. And the dates to pay are April 15th. So on April 15th, we have an estimated payment for the first estimated payment of the year. That's on tax day. So if it's tax day is different, the first estimated tax payment follows that day. Then we have it in June. Then we have it in September. And then we have it in January. Those are the 4 dates. And it's usually the 15th, but it could change every time.
And that's where, hey, so January through March, I make $10,000. I owe $1,000 in taxes. I'm not withholding from this income. So I need to make an estimated tax payment. And I don't make it by April 15th or whatever the day is there. That is, is that two penalties? You have the underpayment penalty and the failure to pay penalty?
No, remember the failure to pay penalty is only assessed if you don't pay your full amount of taxes by April 15th.
Ah, okay.
So let's say you don't make any estimated tax payments and you owe $10,000 on April 15th, 2024 for the 2023 tax year, you pay that $10,000. You're going to get an underpayment penalty, but you will not get the failure to pay penalty.
Got it. And so the failure to pay penalty is the actual tax filing deadline to get it in. So now you're getting cream with the underpayment penalties potentially, but at least you're Xing out that one penalty. And so what is the penalty you owed $10,000, you didn't pay it, forget about the underpayment penalties for now, but just like failure to pay, what is the penalty for that?
So the failure to pay penalty is, let me just look at the notes here. I believe it's 5% of your underpaid taxes. 5% of underpaid taxes, not to exceed 25% of your outstanding balance.
Okay.
So what that means, it's 5% that they're going to charge you, and it's going to, each month, they're going to charge you an additional 5%. Remember, it's all annualized, but if you let it go, it's not going to get to over 25%. However, once you get to that 25% territory, you're most likely going to be dealing with IRS letters and other things, other fun stuff that you don't want to not have to deal with. So.
Yeah, that was sarcasm, folks. It's not fun, because I assume that's when the wage garnish, the full weight of the law comes down because that would be like not paying your taxes for like 5 years or something.
Oh,
right?
I'm sorry. Let me put a caveat. I misspoke. The failure to file penalty is 5%. The failure to pay penalty is 0.5%, not to exceed 25%. So together, those two make up 5%. So what I mean by that is a failure to file is 5%.
Mm-hmm.
If you have a failure to file and a failure to pay, the failure to file penalty is going to be 4.5%, and the failure to pay penalty is going to be 0.5% for a total of 5%.
Interesting. Okay, so but if let's say you file and you just don't pay, then you're getting hit with what exactly?
0.5%.
0.5%
of the unpaid taxes for each month or part of month that the tax remains unpaid.
But each month. Each month it's 0.5%. So, I mean, just simple interest is 6% right there for that per year. With 0.5.
The penalty won't exceed 25% of your unpaid taxes. That's straight from the horse's mouth from the
right.
website.
Okay, 6. So you got like 4 years, and then you'd hit 4 years, 2 months, and you'd hit the 25% maximum. But okay. So really important to pay your taxes on time by April 15th. So let's say, I think for most people, what happens is they get through the year and, well, actually backing up before that. So Charlie, is there any like exceptions to this failure to pay penalty where, hey, I've maybe I paid like 50% of what I was supposed to, or like what are the exceptions to not have to pay the failure to pay penalty?
So when it comes to the failure to pay penalty, the IRS wants its money. Mm-hmm. So when taxes are due, you're legally obligated to pay all the taxes that you owe. Now, what you can do, if you don't have enough money, you can go and ask for a payment plan from the IRS, and you won't get hit with the failure to pay penalty, but you will still have interest charged on you. But you can set up a payment plan, you can work with the IRS. And the thing is, too, we hear about these commercials, like back in the day, Alan Thicke from Growing Pains would be like, oh, the big bad IRS, you don't want them coming to you. We work with you, and we make sure that you don't have those garnishment letters. It's really annoying as a professional to hear those commercials because they all are based on fear. And the IRS is actually a really good institution that wants to work with people. And they're very kind. They work with you. I mean, they're still going to like have you pay, but they're going to work with you. It's not going to be like, oh, we're going to send these garnishment wages, and we're going to take your firstborn child, and we're going to take your house. And it's not like that. So if you can't pay your taxes, work with the IRS. They're more than willing to work with them. They're just like you and me. They're hardworking people, and they just sit there for a paycheck and trying to trying to do the best they can in life. They're not trying to just like rake you over the coals or take away your house or take away everything. Now, when you don't pay and you try to avoid taxes and you try to be fraudulent, then that's where they have, people in the IRS with guns and badges and IRS police that can arrest you. But for the most part, they want to work with taxpayers who want to work with them.
Okay, so that's really helpful to know, and I'm sure encouraging for some people if you have some tax issues, is go to them, and they'll, more often than not, they're going to be really willing to work with you and come up with something to help you out. Not to say that you're going to get out of a bunch of penalties and payments, but they're not like, they don't enjoy punishing you, essentially.
And I would say those companies, anything that the companies can do, I don't want to say anything about the companies because I don't know them, I've never worked with them, but anything that the company does for you for a fee, and a substantial fee at times, you can do yourself with the IRS for free.
Okay, good to know. So that's failure to pay, which is essentially if you don't pay it, go get on a payment plan with the IRS, go talk to them about that, and they'll help you work something out with you. But now underpayment penalties, that's where the 8% penalty comes in a year.
Well, the failure to pay penalty is 8% as well, but that's like, it's separate. So the failure to pay is a penalty. The 8% is an interest charge.
But they're both called penalties, but they're separate. One's an interest charge.
So you're going to get penalized, like a penalty, like you owe $50 as a penalty.
Right.
But then you're also going to have the interest charge on the underpayment of taxes.
Got it. So these are two separate penalties, taxes, whatever you want to call them, additional payments.
Correct.
Okay. So let's say then, I think most people, what happens is, okay, I went through the year and, come tax time, file my tax time with my CPA, like Charlie, it's like February, and it's like, oops, like maybe I owe a little bit of money. That's going to be, and then they pay that money, they pay it up before April 15th. So they're not going to be subject to the failure to pay penalty, right? But then they still can get hit with the underpayment penalty. Correct. Okay. So let's talk about, I think we've kind of gone through like, hey, you just got to pay quarterly, essentially, pay as you go, make sure you match it up. But so let's say you haven't been doing that. What are there any like exceptions to the rules that you don't have to get hit with this underpayment penalty, or you kind of just, you're done? Yeah.
So it's all going to be based on your own personal situation, which is where the tax planning can really help. But if you recall, what we talked about at the beginning was called the safe harbor rule. So if you're making a lot of money in 2023, but you didn't make a lot of money in 2022, and you're looking at how much you made, you need to pay 100% of the taxes you paid in 2022. Even if you owe $50,000 more in taxes, let's say for 2023, as long as you pay safe harbor, which is 100% of 2022 or 110% of 2022, depending on your income, you can avoid underpayment penalties.
Interesting. And now you mentioned too, if you're a high income earner, it was like over $150,000. Was that 110%?
110%. Okay. And that's adjusted gross income. That's for joint income. If you make over 75,000 as a single filer, it's 110%.
Got it. Okay, so 100 or 110% based on your income from last year, and the taxes you owe so 100% of last year's taxes or 110% of last year's taxes. Those percentage figures will change based on your income. If you just at least pay that, and in the current year, you won't owe any underpayment.
Correct, but remember, you still have the 25% rule too. So you still got to get that in throughout the year. You can't just make a $10,000 payment in January. You're still going to get the 25%. I call it the 25% penalty, but it's basically the pay-as-you-go penalty. This is all just, it's not official terminology here, but it's kind of right. You got to do that 25% rule too.
Yeah, you still, even if you underpaid through the year, you still need to pay it before the tax before your
Correct. You
tax
got to
return.
match up your income. So
Yeah,
let's
you
say,
gotta.
so let's say you owe $10,000. You have to put $2,500 each quarter.
Mm-hmm. Okay, okay. I see what you're saying. Oh, interesting. So even if like you owe 50,000, but your taxes from last year was $10,000, you're under the income limit, so you just need to make 100% payment for last year's taxes. Last year's taxes were $10,000, so you would only have to make $2,500 each quarter, but you
Each
still
quarter,
need to
but you
make
got
it
to make
each
that
quarter.
2,500. Otherwise, you'll get the underpayment penalty because you're not matching it up based on last year's taxes.
Ah, interesting. Okay. Okay. And now what if last year's taxes wasn't even? Like you had, you owed 2,500, 2,500, 0, 5,000. Would you have to match it up
No,
that way as
so
well?
it's just based on your total tax for 2020 for the previous year.
Okay. Okay. Um, interesting. Okay. So, and then anything else from there, or that's
So yeah, so you
basically
have
it?
that, and then the other way is, so now let's go the other safe harbor method, which is 90% of your current year taxes. So let's flip the script. Let's say now in 2022, you guys banner year, retirement, you got a big severance package, you got this huge, you're making a ton of money in 2022. In 2023, you're retired now. So you don't have that big income that you had in 2022. So then what you have to do is you have to do 90% of your taxes due for the current year to avoid an underpayment penalty. And that's got to be throughout the year, matched up when you made the income. So by January 15th, you have to pay 90% of your taxes to avoid a penalty.
Oh, okay. But so that's nice where, hey, if you owe 10,000, you have to pay 10,000, but you were at 9,000, you withheld it correctly throughout the year or made the estimated payments throughout the year, you're not going to get dinged on that last $1,000.
Correct. And I do want to say if I said got to pay all your taxes by January 15th, I just want to say that's based on the safe harbor of 100% of the previous year. You can just pay 90% of the current year. So I do want to clarify that from previous when we were talking about it.
Got it. Yeah. Yeah. But it seems like you can essentially do the lower of the two.
You wanted to, yeah. I mean, why pay more to Uncle Sam if you don't need to? Especially
Yeah,
with rates these days. I mean, you can get 4.5% in a high interest bank account. That's
Yeah.
money in your pocket versus Uncle Sam's paying you a big fat.
Excellent. Okay. So that's actually pretty simple. Hey, either you use last year's payment of 100% or 110%, depending on your income, or you got to pay 90% of the taxes due this year. Either of those two, as long as you do that and withhold correctly throughout the year, you're not going to get hit with an underpayment penalty. And then you true it up. You make sure you make that payment before tax time. You're not going to get hit with any penalties.
Correct. There's a caveat though. So the underpayment penalty, if you have variable income, that's where that form 2210 comes in. Because if you have different income throughout the year, the IRS is going to treat it like you made it equally throughout the year. And if you have a big Q3 payment, let's say, and you don't tell the IRS you have a big Q3 payment, they're going to think you made that money equally. So they're going to make a penalty because they're like, oh, you made this money equally. Like you have a big Q1, big quarter. But it's really, no, I only had big Q3, guys. You got to let the IRS know. And that's a form 2210.
Oh, interesting. So what I'm kind of hearing, Charlie, is that the IRS assumes you make your money equally throughout the year. Even if it's not, that's not, you make no money in the December, you make $100,000. You have $100,000 for the year, but it all comes in December. The IRS just kind of defaults to, oh, we just assumed that Charlie made that $100,000 evenly throughout the 4 quarters of the year.
Right? Yeah. If you don't tell them, that's what they think.
Okay. So
Just like withholding.
But what do you mean by
withholding? They assume is equally throughout the year too.
Got it. Okay. So then, and now I guess on this example while we're on it, December, you make no income for the year. December, you have $100,000. You could do a $100,000 Roth conversion, for example. And you withhold all the money from the Roth conversion. You withhold the taxes from that. Is that going to be that wouldn't be a penalty because they assume you've kind of like, you didn't meet, they put it equally. and it's going to go through the year, and so there'd be no underpayment penalties.
Right, because they're going to, even though you did it in quarter 4, they're going to say, oh, you made these withholding in quarter 1, quarter 2, quarter 3, quarter 4. But to that example, I would actually recommend not doing a withholding and doing an estimated payment, because if all your money's in quarter 4 and you pay a quarter 4, it's just an extra form you got to fill out on your taxes. So it could be an extra charge with TurboTax or however you get your taxes done. But then you get to keep the money and keep it in a high interest bank account, versus withholding, it just goes to the government and you can't earn any interest on that.
Got it. Okay, so that's really helpful, and especially so with variable income, I think for a lot of folks, what I see is, hey, well, actually, let's take Social Security out of this. Hey, we're just getting money from our IRA each month. We're withholding, like we've got this system set up, and then come December, I tend to lean towards, let's do Roth conversions towards the end of the year, so we have a good idea of your income. There's no surprises. And then, so you want to do a Roth conversion at the end of the year. That's going to cause your income to be variable, right? Because you might have this spike in income Q4. So what do people need to do to avoid underpayment penalties?
They want to match up their income with your estimated payment. So for your example, they want to make a quarter 4 estimated payment for their Roth conversion in quarter 4.
Okay. And quarter 4 means, again, assuming
October through December.
Okay. Now, can you do it January 15th of the next, up to
January?
January?
So that's when you earn the income. And then
right.
You can pay the estimated payment by the 15th of January.
Okay. And now what I sometimes like to do with people is, especially if, we're want to fill up like the 12% tax bracket, we want to do a Roth conversion, fill up the 12% tax bracket. We're going to use outside funds to pay the taxes on the Roth conversion. But we might need to sell some investments in like a taxable brokerage account. We might need to recognize some capital gains. One thing we like to think about is, hey, let's do the Roth conversion. We're going to max out the 12% bracket. And then beginning of next year, right around now, we're going to sell some investments. We might recognize some capital gains, but then that will be on 2024's taxes. That won't impact 2023's taxes, so we can get more money into the 12% tax bracket. Don't have to worry about double taxation with the capital gains income, and then make that estimated payment before January 15th for the Roth conversion for 2023 taxes. Does that all sound like that sounds good to you? Is there any thoughts there?
Well, the one thing I like about that too is if you're in the 12% tax bracket, you pay 0% in capital gains as well. So if you do that method, then you're not paying anything for the capital gains that you're selling if you're in the 12% bracket for 2024 as well, which is neat.
Yep.
Now remember, if you go, that is going to take away the income that you can do in 2024, but that's kind of par for the course, because you want to stay in that 12% bracket. Because if you go above the 12% bracket, then you have to pay taxes at capital gains rate for long-term capital gains. One thing to note about that capital gains rate, that's only true, 0% capital gains rate for long-term capital gains. Short-term capital gains, which is a year or shorter, does not have that 0% rule.
Excellent point. So, I think that pretty much covers everything. I mean, I feel like I've got a really good understanding, Charlie. This has been fantastic. And also, I know we're a little bit over an hour. Do you still have a couple more minutes, or you got a...
Yeah, no, I'm okay. I have until noon, so...
Okay, great. We'll wrap this up quickly. But, I mean, this has been really helpful understanding withholding, the difference between withholding, estimated payments, the penalties that happen if you don't make your tax payments on time. And it sounds like there's really two main separate ones, assuming you file a tax return, which is, hey, if you don't make the tax payments align with the income, then you get hit with like kind of like an interest penalty, like paying a credit card off late. You kind of have to align your tax payment with when you earn the income, and there's some you get there's some grace there. There's a little bit of time with that. So you have that underpayment penalty. And then 2, of course, there's, hey, you still need to actually pay the taxes you owe before the tax filing deadline.
Mm-hmm.
So that's all great. And knowing that withholding happens throughout the year, the IRS just says, hey, we assume if you make a withholding whenever it is, that goes equally throughout. Oh, actually, Charlie, that reminds me, if you make a big withholding January, or maybe not January 1st of the year, but like February 1st of the year, does the IRS assume that money is for equal installments going forward, or does it only look back with like the equal payments throughout the year?
No, it looks forward too. So what's going to do, the IRS is going to look at, okay, how much is you making quarter 1? And they're going to take whatever withholding you have and apply it there. If there's any extra withholding, it's going to flow forward to quarter 2, then flow forward to quarter 3. So it'll go forward if you make a big withholding payment at the beginning.
Interesting. Yeah, so simple enough. Pay your taxes. It's kind of a pay-as-you-go system. Make sure that the tax payments are roughly aligned with when you earn the income, unless you have some of the safe harbors to think about, like last year's income taxes were a lot lower than this year's to think about, or you can use the 90% safe harbor rule as well. With the last minute or two here, Charlie, I'd love one to just hear your thoughts on Roth conversions. Do you help people with that? Do you help clients with that? Do you, and in general, like, are you a fan of the strategy or not? I would love to just get your thoughts on them.
Yeah, that's a great point. So when it comes to taxes are going to be one of the biggest things that you pay in retirement. And the whole strategy working with a planner is to try to pay the least amount in taxes over your lifetime. So what we want to do is we may pay more taxes now because later on we're going to pay taxes at a lower rate. And that's what we want to look at when it comes to Roth conversions. How much is your overall tax rate going to be? If you're in the 12% bracket like Larry brought up, maybe it makes sense to pay more taxes now because we won't be paying taxes later. When we have required minimum distributions and we have to take money out. We can't really thread the needle anymore. So making Roth conversions is a smart strategy depending on your situation. If you have a huge amount of income, maybe it's not a lot. But hey, maybe if you have a lot of income, you're going to be at a lower rate now, even though it's a higher rate for everybody else than in the future. So it might make sense to do something at a higher rate now. It all depends on your situation. So overall, I like the strategy of paying the least amount of taxes. And there's other ways that you could do that, whether it's through a Roth conversion or whether it's through capital gain management, whether it's through charitable gifting, whatever it may be. It's one tool in the arsenal. So when it comes to Roth conversions, though, that if it makes sense for you, I do like it. At the end of the day, you also have to keep in mind Social Security is taxed at a higher rate if you make more income, and Roth conversions can have Social Security get taxed more. So even though you're in the 12% bracket and you stay there, effectively you're paying over 20% in taxes because more of that Social Security is being taxed at a higher rate, but you're still in that 12% bracket. So that's something to watch out for if you are Social Security eligible and taking Social Security. But the magic time is before you take Social Security, after retirement, when you really have flexibility with your income. There's a lot of cool things you can do there. So overall, yeah, I think that Roth conversions are a neat tool.
Music to my ears. Depends on your situation. Got to think about tax rates today versus the future. And of course, I like to call it like the stealth taxes with, like, Roth conversions can increase your Social Security taxation or cause your capital gains, the long-term capital gains to get bumped from the 0% bracket to the 15% bracket. So that's great. Charlie, I think this, we're kind of wrapping up here, coming to an end. I want to ask you about how people can get in touch with you and whatnot. But before I do that, is there anything else you think we missed, wanted to talk about here, or like go back to something before we wrap this up?
No, I think we covered a lot here. I think it's good. yeah, 2024, let's make it a good year. Hopefully there's no pandemics out there that cripple us and have us stay at home. But yeah, it's going to be a fun year. Pay your taxes, get your taxes in. And if you have tax situations where you can't pay your taxes, I can't stress it enough. The IRS isn't out to get you. They're there to work with you. And then for me, I know, Larry, you asked about where you can get a hold of me and everything. So my name is Charlie Horenzi, and I own Focused Up Financial. You can find me at www.focusedupfinancial.com, and I mainly work with retirees and all these strategies we talk about. And also, being a CPA, I do prepare taxes as well for clients if you guys would like. So get in touch with me. Love to hear from you. Love to hear your story. And yeah, just I'm trying to get to those 50 states, so you might see me there. So
now, Charlie, you're where are you based?
Oh, I'm sorry. Yeah, I'm based in Chicago. My office is in LaGrange, Illinois, which is a Chicago suburb. But I work with clients virtually, nationally. So depending on where you are, with the magic of Zoom these days, we can get together.
So you take that Alaskan client, so you can go. You meet with
I would
somebody
take
from
that,
Alaska,
yeah, and then I could write it off as a business deduction.
and have got your goal of 50 states.
There you go.
Perfect. Well, Charlie, I appreciate the time. I don't see any comments from anyone, and check Facebook too. Yep. So I don't see any comments on here. So we'll wrap it up for today, but appreciate the time. Good talking taxes with you. I think this was incredibly helpful for people clearing things up because the underpayment penalty and the failure to pay, there's just two different ones, and it gets really confusing and withholding versus estimated payment. So this was excellent. Thanks so much, Charlie. Appreciate your time. And we'll have to have you back on sometime.
For sure. Well, thanks for having me. It was a great time. Yeah. Good luck to you guys. Pay your taxes and save money on taxes too.
Awesome. All right. Take care, everyone. We'll see you around. Thank you. Bye.
Bye-bye.